Hello and welcome. Today we're diving deep into the latest insurance risk dashboard from EIOPA. If you're a risk manager in the European insurance space, think of this as your essential briefing for what's on the horizon, based on all the key data from the first quarter of 2025. So here's our game plan. We'll kick things off with the big picture, then drill down into solvency and profitability. From there, we'll tackle two of the biggest growing pressures, ESG and cyber threats. And we'll wrap it all up with the key takeaways you can plug right into your risk framework. All right, let's get into it. The main headline from EIOPA's latest assessment, well, it paints a picture of overall resilience. But, and it's a big but, there are some pretty significant storm clouds gathering on the horizon. And that quote really nails the theme for our entire explainer today. The foundation is solid, sure, but it's being tested by a really complex and unpredictable world out there. This whole stable but idea, that's the central tension that every single risk manager is grappling with right now. So what does that stability actually look like on the balance sheet? Let's take a look at the sector's financial health. And we'll start with the metric everyone watches, Solvency II compliance. The number you need to know is 197.8%. That's the median solvency capital requirement ratio for insurance groups. Now, anything over 100% means you've got enough capital for extreme losses. So on the face of it, that is a very, very healthy number. Okay, you might notice that's a small dip from the last quarter, which was at 208.5%. But let's be real, a median solvency ratio that's still pushing 200% shows a sector that is incredibly well capitalized and resilient. The key point here is that even with all those market pressures, the fundamental capital position is holding strong. And this isn't just an illusion from the aggregate view either. When you actually break it down, you see strength right across the board. Both non-life and life businesses are posting solvency ratios that are comfortably over that 200% mark. It's a picture of widespread stability. Now, when we look at profitability, the story is a bit more mixed, but it's still generally positive. The real standout here is that non-life combined ratio. It's improved to 95.5%, which points to much stronger underwriting discipline. You pair that with an increased return on assets, and it shows insurers are, at least for now, finding ways to navigate these financial headwinds. Let's shift gears now to one of those areas with a negative outlook I mentioned. We're talking about the complicated and fast-moving world of environmental, social, and governance. You know it, ESG risks. The data here shows something of a contradiction, which is a real puzzle for risk managers. So on one hand, insurers are definitely upping their game, increasing their holdings in dedicated green bonds. But at the same time, their exposure to other climate-relevant sectors, think energy-intensive industries, has actually dropped a bit. This split creates a huge challenge. How do you get a true reading on your net ESG exposure when your portfolio seems to be going in two different directions at once? And this is the bottom line from the supervisors. Even though the current risk level is sitting at medium, the arrow is pointing up. The clear expectation is that risks from climate events and policy changes are going to become much more significant over the next year. This is an area where you just can't afford to look away. All right, let's pivot to the other major risk that's trending in the wrong direction, and it's one that lives right inside your own four walls, the cyber threat. This is a really important shift in thinking. We're not just talking about the potential impact of a major cyber incident anymore. The conversation has changed. Now there's a growing belief among supervisors that the probability of an attack actually happening is going up. This quote from EIOPA just hits the nail on the head. It perfectly sums up the unique tightrope the insurance industry has to walk. Cyber risk isn't just some external threat you insure, it's also a deeply internal operational one. You're basically fighting a war on two fronts. So that dual challenge really splits into two key battlegrounds. First, you have the operational risk, just protecting your own house, your systems, your data. And second, there's the monumental underwriting risk of trying to price policies for others when the threat landscape is shifting under your feet almost daily. If you get either one of those wrong, the consequences could be huge. Okay, so we've looked at the stable foundations and those growing pressures. What does this all boil down to for you, sitting in the risk manager's chair?
Let's distill all of this into the absolute must-knows for your risk framework.
Here it is, your risk horizon checklist. 1. Your capital base is solid, but keep a hawk's eye on profitability metrics. They're your early warning system. 2. That ESG risk outlook means you've got to dig way deeper into what's really inside your portfolio. 3. Always treat cyber as the two-front challenge it is. And finally, never forget that core theme. Stability feels good, but it's no excuse for complacency. Vigilance is everything. So we'll leave you with a question to take back to your team. You're standing on solid ground right now. That's clear. But those pressures are mounting. So which of these forces, the green transition, the ever-present cyber threat, or the choppy waters of market uncertainty, which one is going to be the defining feature of your risk strategy for the next 12 months? Thanks for joining us.